Let's get into that discussion now. The question we asked you is, should banks be allowed to set their own interest rate? And the question is coming up on air. Should banks be allowed to set their own interest rates? You can text us using 22422. The hashtag is Daybreak at Trevor Mbija at Zinzi Kibiku. You can have your views live on air as well.
All right. Speaking of that, let's just set the scene and the stage for you as our viewers at home by beginning to define what a capped rate is. All right. So a capped rate, according to the World Wide Web, is an interest rate that is allowed to fluctuate but which cannot surpass a stated interest limit. So the lead rate structure also allows some protection to the lender. Trevor? It's
interesting that you bring out definitions, because that is where the bone of contention is. A three-judge bench, that's Justice Francis Tuyot, Jacqueline Kamau and Rachel Ngetich, said that there are several terms that appeared several times. One of them is central bank rate and credit facility. So they're giving Parliament a chance to amend the Banking Act and bring and clarify those anomalies, because they say the word at no more than 4% the central bank rate is vague, because according to them it could mean no more above or below.
So the objective of this conversation this morning is to make sure that we understand the sort of influence this will have on our businesses, on our homes, if you have taken loans and so forth. And we have a fantastic panel.
Yep.
For the sake of our audience who are just joining us, these are the brains that we have. On my right, I have Felix Bugwa, rather. He's a tech entrepreneur. He will help us understand the whole aspect of digital borrowing, how that has happened, the effect it's having on the economy. Do they also need to be limited in a way to protect the lender? Get this, 26 to about 35 years is the average digital borrower. That's a millennial, all right? So they're the ones who are borrowing a lot from the digital platform. Sitting next to Felix, we have Peter Nyaga. He's the CEO of Mahiga Homes. Again, real estate is one of the key places that this might influence. And at the center, we also have Shiv Arora. He is a site and investment manager. Just also help us understand the sort of influence this will have on our investments. One key aspect that also comes to me, and I'd love to hear his thoughts, is, should Kenyans still be trusting? Do they have confidence in banks at this rate? We've also been seeing what's happening in the banking sector. And of course, the one and only Honorable Jacoya Midiwo, who is also the former Member of Parliament of Geni. Gentlemen.
It's also important to mention that we did invite the Kenya Bankers Association, but they said they cannot comment on this matter at this point. They needed time to go through the ruling until Friday. Right. But there's been a counter-accusation that they're part of the team that also sponsored the petition. So we'll find out from them when they come and speak about it. But first up, let's talk about this issue. And Honorable Jacoya, I'll start with you. There's been, COFEC has gone to court actually to counter this. They're appealing this ruling. From where you stand, was this justified in any way?
So let me say that I'm seeking to enjoin myself in that appeal.
Okay.
Because as you know, history has it that this issue of capping of interest rates was first brought to Parliament by the MP that I took over from, called Joe Donde. I then took it up. For many years, we could never make progress until President Uhuru came to power. And even that, I had to sit down with Jude Jomo for us to get the requisite numbers. Jomo became the sponsor of the bill.
That's the Kiambu legislator.
The Kiambu legislator. And you know, for all the years, I'm not surprised that Kenya Bankers Association has not showed up.
They said they needed time to go through the
but
ruling.
they would not need time to slap you with higher interest rates. They would not need that time. They need to explain to Kenyans what they're doing. I'm happy today, Trevor, that we are in a panel of very intelligent people. These are Kenyans who are trying, but who would be so affected by negative interest rate, and that's what I call it. It is not justified. The ruling is suspect. I was so happy yesterday that JSC took a judge, recommended to the president to investigate a judge who refused to appear before JSC. So these courts, some of them are making rulings that have no conscience. Like, this is a ruling without a conscience. You know, you cannot tell us. So in that case, the judge has been mentioned everywhere. He has even has the audacity not to appear so that he can go face his accusers. I really wish, I was telling a friend last night, that Justice being that he is a Supreme Court judge, Parliament must step in. Okay. Because there is no way a tribunal can hear him if he refuses to talk. You know, lawlessness is lawlessness. And I've been saying our next port of call after politicians should be the courts. This is a ruling without conscience. And why do I say that? I drafted this bill maybe like 18 years ago. Yeah. There was always the issue of CBR rate. The word CBR rate, central bank rate, is defined in the Banking Act, not in the, it is already in law. So for a judge to say that it is ambiguous, I mean, would it be ambiguous to a choke around the streets? When you hear the word central bank and you hear the word rate, what are you telling Kenyans as a court? It means the ruling is suspect. And trust Kenya Bankers Association to try to find their way out of this. Let me just finish my thought. Then they also say that the phrase credit facility is vague.
Was not defined.
Please. And not only not defined, it is unconstitutional. You know, as the drafter, the sole drafter of Consumer Protection Bill, which occasioned Article 46 of the Constitution, I can tell you, somebody is rogue. And I hope Kinoti is watching. And we want to know what happened before this ruling. Because this is, you know, you're dealing with 50 million Kenyans. Okay. A good percentage of them, and good business people like the ones we're sitting with in the panel, depend on banks to make Kenya moving forward.
Though it's also fair to say that they've given you, the legislators, 12 months to rectify their anomalies.
They don't have that power. Yeah. What is that? What kind of ruling is that? That you tell Parliament that supposedly committed a crime to go and redo the law. That is, Parliament is an independent institution, does not take direction from the courts. If the law is unconstitutional, period, it is unconstitutional.
Mheshimiwa, talking about laws and the bill that you're also championing for, is it possible that interest rates can exist without proper legislation?
Not anywhere on earth, do they? Remember when Obama took power during the economic slump? He worked with the Fed to make sure that how the mortgage rate, lending rate, in the United States is below 1%, 30-year mortgage. Okay. What is so, these banks, Zinzi, did you see that so far, before the end of the financial year, they have made 153 billion shillings? Okay. What else, how much more do they need from Kenyans? Okay. I am of the view, as I finish, that Parliament, Jude Joma, and I've spoken to him, they need to take this opportunity. Let them not disobey the court. Take the opportunity and close what is called overnight lending window. Because the banks are not financing them, because the banks go to the government and give government money overnight for a profit of 19%. Okay. Where on earth does that kind of thing happen? So the country is beholden to the banks, and the banks, majority of them, the money is being exported.
Shiv, Mheshimiwa is calling it a ruling without conscience, but in 2017, IMF itself said the interest rate should be scrapped because, quote, it stifled credit access for small and micro enterprises. The CBK data itself shows that growth of the private sector has gone down since 2016 when the interest rate came in. What do you make of that? Should it be reversed now?
As Citon, we've been very vocal that the interest rate cap must go.
It must go.
It must go. There is... we also siphoned it. When you look at Kenyans, and it's a very different view, but I think the outcome is the same as what Mheshimiwa is saying. Interest rate caps in Kenya are like Kenya's Brexit. They are very popular, but it's very unwise. You have Kenyans baying for blood. Banks are making excessive profits. Interest rates are too high. Banks are charging a lot of people. They make a lot of money. But at the end of the day, banks are a very important intermediary in business. You see manufacturing businesses making profit, you see banks making profit. Everyone is entitled to operate in a business environment. From an interest rate cap perspective, rather than place a cap on interest rates, because what government needs to do is create a conducive business environment within which private sector can operate. By going in and capping interest rates at 4% above CBR so that you can fix the rate, you've actually not achieved anything. Because if you actually go onto costofcredit.co.ke, which is actually up there by Kenya Bankers Association, if you go to actually take a loan, by the time you've calculated all your fees and all your repayments back, you're actually paying 16 to 17% per annum anyway. So there needs to be a different movement away from interest rate caps. And I'll give you an example in developed markets. The first is that you create a strong consumer protection agency, which then looks at the rates which are being charged to different individuals. The second is you increase access of capital in other sectors of the economy. Rather than stifling the banks, why don't you encourage alternative sources of capital? In the developed markets, only 40% of funding towards businesses is from the banking sector. 60% is from alternative sources of capital, such as the capital markets, corporate bonds, IPOs, people going and raising money through listing their companies. 40% in developed markets, 95% in Kenya.
Shiv, I hear you. The fact that we should look for alternative sources when it comes to capital, the IPO, the shares and so forth. But how do you expect a student from university who has a fantastic business idea to go buy a bond, to be involved in an IPO, to go buy shares? How do you expect a university student, Mamamboga and so forth, who hold the economy, the SMEs?
It's definitely there is the part of the economy which has to borrow. They need access to credit, but they need access to credit in a regulated manner. And the last point was going to be, if you have clear information on loan pricing. Today in the United States, in the United Kingdom, you can go onto a website to get a car loan or a starter loan for your business. You key in your credit score details, your credit history. It will give you all loans that are available from the different banks and the rates at which they're going to charge you. You will automatically go and select the most competitive loan for your business. Okay. We need to get to that point of an economy where information is transparent, because today we don't have that option as borrowers to actually go and in one place view almost a supermarket of credit that is available.
All right, I'll come back to you and find out when you say that you have to go and compare and get a competitive one. If the competitive ones are between 20 and 30, and then this is the government is trying to regulate it at 15, isn't the 15 better than the 20 and 30? Because the banks can just decide and make the most competitive to be at 22%, and the least is at 30. So what would you do?
Information will definitely drive down prices. Alternative sources of capital will drive down prices. At the moment, there's no competitor towards credit in the banking sector.
So there needs to be more competition on that.
And you were right in terms of credit to the private sector. A target of 18.1%, it's hovering around 4%. Today, no one can get a loan because government is borrowing infrastructure bonds at 12.5%. Why would someone lend to an individual or an institution at 13%. The risk reward doesn't work.
Hold that thought. But Peter, from a real estate perspective, what is your position on this? Should the interest rate cap stay or should it go?
From a real estate perspective, I would say that the interest cap rate should go. But at the same time, banks should not be allowed to regulate themselves. The central bank should regulate. But, you know, we are in a capitalist market. That's a free market. So it has not been even about interest rate cap or the regulation. It has been about safeguarding the interest of the customer or the consumer. Because what has happened, there's been a low intake of mortgage, of loans, because banks are shying away from lending because of the interest cap rate, and also because of what we call secure lending. because bank want to be sure that we are giving you money, you pay back. You know, previously, before the interest cap rate, banks would lend money because they would regulate themselves on interest rate. So they would lend money. If one default, 4 will not default. They will cover up.
So it covers the bad loans.
Yeah, they will cover the non-performing loan. Yeah. But what we are experiencing because of the interest cap rate, they have to be very sure that this person is creditworthy. Is not going to default because they don't have something to caution themselves. Right now, banks are vulnerable. They don't have that they can't pull, you know, the lenders, so that they are covered when there is bad loans.
Comparing now in 2016, with the uptake of the homes that you're dealing with, what have you seen? Is there a big difference?
Yeah, there's a big difference because right now people have no purchasing power like before because banks are not renting to people want to purchase properties. So if there is no disposable income, people are not able to invest in real estate. So my take is the interest cap rate should go, but you know, previously the bank have set abnormal rate, which leads to abnormal profit. That's why the central bank comes in and regulates that.
But Peter, won't this not make it difficult for Kenyans to own homes, their own homes?
It will not make it difficult because banks are lending. Kenyans have money to buy. No, the central banks come in to regulate, to regulate how far the banks can do, the interest rate, how far it can go. But it's not be capped. Okay. It should not be capped because if we compare when the interest rate was like so banks could regulate, you could banks were not limited on the interest cap rate, the uptake of loans. People were borrowing, banks were willing to lend, but right now they are very careful.
Okay. All right, gentlemen, listen to these statistics that we received when we were doing our research. 230 billion Kenyan shillings is the amount in loans that M-Shwari had dispersed by the end of 2017 since they launched in 2012. Even more surprising is the fact that 59% of self-employed Kenyans are digital borrowers and they use credit for their businesses. I think the most classic example is the fact that Mama Mboga will wake up at 4 a.m. She will take a quick mobile loan, and by midnight she will repay it the next day. And that's how she grows her business. But Felix, do you also think that mobile or rather digital borrowing should also sort of be fenced to protect lenders?
Now, I will look at it from very many angles. And from a technology point of view, the reason why the mobile lending apps are giving banks sleepless nights is because they have eased the access of money by the common person. Now, if you notice and if you look at the interest rates of those mobile loans, they are way higher than when you talk of interest rate capping by the banks.
They also need to be looked into.
They basically don't need to be, not exactly that they need to be capped. The point is, the common mwananchi is borrowing at a very high rate, and they're accepting the terms of a very high rate because there is ease of access. So that should be a point to ponder on for the banks. It means that even when you have a low rate, that does not mean that everybody is going to run to you. It actually means that if they don't have ease of access in terms of your process of accessing a loan, then even if you are at a lower rate, they will not come to you. They will go to the person who gives them the money first. That is why the mobile lending apps are giving banks sleepless nights.
And as much as they're becoming popular, don't you not still think that the government needs to make sure that they keep a limit on it? So then again, that way even Kenyans, Mama Mboga, who I've given a classic example of, doesn't have to dig deep into her pocket.
Because it borderlines on exploitation. You're the one who's saying that their interest rates are even higher. The only difference is that they're accessible. So people go to them because they have no choice. I need the money now, not necessarily because I'm happy with the rates.
And this is where now we call on Mheshimiwa and the technocrats, because you see, the mobile lending apps are not registered. Some of them are not, they are not even captured in the Banking Act. You understand? This is new, this is technology, this is something that has come in. So like the way you have SACCOs and microfinances and banks having a law that governs them, you do not have somebody governing something on your phone in terms of money. Okay? So basically what happens is the law has to be looked into to a point where it actually has to bring everybody in. Look at it this way. Safaricom has to battle with the CBK to actually have M-Pesa being accepted and for them to even push their limits and everything else, okay? This is because Safaricom, first of all, is not a bank.
It's M-Pesa that is a bank.
And M-Pesa is a financial facility that, and M-Pesa is not a bank as well. That is why for Safaricom to be able to loan to you, Safaricom can say this is technology that allows me to move money to you. That is why it's called M-Pesa, allow me to move money. Then you're told, okay, I want to lend money on M-Shwari. You're told, no, 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 no. The only people allowed to lend money are banking institutions, okay? So M-Shwari has to be in partnership with CBA for you to actually to be able to access money. So basically the challenge we have is that these technology companies are not defined anywhere in law. And basically for them to be capped or for them to be addressed, for them not to fleece the common mwananchi, they have to first of all be given a category in law so that when they are registered registered under that category, and then now they can actually be regulated.
So in your position, should the interest rate cap go or stay?
It's a sword that cuts both ways. If it stays and there is access to money, no problem. If it goes and there is no access to money from the banks, then it's still a catastrophe.